Hello, Oakbrook here, and this is going to be looking at Watkins Jones. Yes, this is one of my Oakbrook 25 for 25 ideas, and this is an article I actually published this morning. So it's normally try and do these things the other way around, but I've not managed to do that, and I thought, well, I better show my face on YouTube, otherwise my YouTube channel will start to look a bit dusty and out of date. So it's been a little while since I've done a video on here, but yeah, look, hopefully looking to just cover this off. I've added some more detail this evening, so if you've read this article this morning, there's more to read, I guess you could say. So Watkins Jones is a builder. It's involved with build to rent, purpose-built student accommodation or PBSA, um, affordable homes, and then also runs a student accommodation management service. So they'll run a halls of residence or a PBSA building on behalf of a university or a landlord of some description, might be a private landlord, and also does what's called a refresh business. So a refresh business being to um, improve or renovate a PBSA, a student accommodation block. So that those are the five areas of business. So what I covered in this article was the 2025 results. Kind of felt a bit painful, and there's a couple of reasons why. We'll go into those. But fundamentally, this has gone up since since 19p when I included it 12, well, pretty much 12 months ago now. And I suppose this is the screen grab from the original article where I said, like I'm including it at 18.98p, I think it was. And I think it's got a good chance of going up by 50% during 2025. And here we are. I mean, it's not quite 50%, but it's roughly that. Is it time to cash in the chips and say, no more Watkin Jones? So I would point out that it reached 40p during the summer, and it's dropped back to sort of 27, 28p. I think it's 28p this evening, and yeah, so it was sort of up here at 40p for a while. So it more than doubled during 2025, and that was really on I would say down to an improving market, and the interim results were strong, where clearly the purpose-built student accommodation market is not quite as bad as some people make out. That it's heading, it's potentially at the bottom of the cycle, and so I guess the question is, if you hang on for the rising of the cycle, then I suppose that's the thing you want to look for. Is the pipeline improving? Is the outlook improving? But also, there's some legacy issues around cladding that we need to talk about as well. In the article I wrote, it was only about a month ago, where I looked at Watkins Jones, and it was on the back of the trading update in October. I guess the five things that I said in that article was that they had managed to complete projects on time, on spec, on budget, which is always what you want on a project if you've ever done project management, and that they had employed careful cash management. So they'd not gone and spent their cash pile on anything crazy, which is always a good thing. That they were enjoying some success with refresh, that interest rates, and particularly the 5-year swap rates, which is what a lot of mortgages or finance for property is based upon, sort of loan rates, and that had dropped to 3.6 or 3.61, and that there was in fact robust PBSA demand in the market, that um, that students are still going to go to university. That we're not all going to just employ an AI that will do all the work for us, and we all sit at home and put our feet up or something. I don't know. I think most people are busier than they've ever been. So the fallacy of no more education or no more something is just not the case. In fact, there's far more people now that are wanting to go to university and see it as a vital part of their personal development. It's the numbers going, the proportion of people going, the proportion of young people going to university is far higher than it's ever been. Yeah, that's so around the successful completions, there's a couple of things that I noticed. The increase of margin was one thing that I noticed. So you'll see here last year, well, if we go back let's go back 6 periods. So first half of 2023, 10%, 7%, 2024, 11%, 8%. And then this year, 12.5% gross margin percentage and 13.2 in the second half. So everything's heading kind of in the right direction, which is good to see. So we're not seeing margins being eaten away by inflation or by costs going up or different things going wrong. Now, Watkins Jones don't get it all their way in the account, so we're going to talk about why that's actually a really good result. But let's get into the individual set. So I said there's five areas. So the buy to rent, first of all, again, what I did was I broke this out because this isn't immediately apparent until you do break it out by half years. That we see sort of 10%, 9%, 7%, 8%, 9.6%. So we see an improvement once again here with the build to rent, not buy to rent, build to rent, and we see 1.4 million, sorry, 1.2 million growing profits half year to half year. That they've got 1,700 homes scheduled for the coming year. So they've got a good pipeline, and this pipeline of 0.6 billion is up 20% year on year. So really, that's encouraging to see. So if you want evidence of a bottoming out and a rebound, 20% increase to pipeline is there's some evidence straight away. I think another interesting thing, and this is something I picked up in the presentation deck from them, is that there are 5.4 more properties coming off the rental market than there are additional properties being added to. So last time I looked, when the hole at the bottom of the bucket is 5.5 times bigger than the amount of water pouring in at the top of the bucket, well, I'm sorry, but your bucket is going to be emptying itself out no matter how no matter what you wish for. That the fact is the bucket is emptying faster than it's filling. So part of that, or a lot of that, potentially a lot of that, is the increasing legislation and red tape and moves made by the government to make life difficult for non-professional landlords. If you are not a professional landlord, as in you're willing to make very large investments in dealing with red tape and having software and systems and different aspects to manage your portfolio, and you've obviously got to grow it to a certain size as well. I mean, it's no longer the case that you can have um, a property as your retirement, as your pension plan or something like that. I think there are a few still trying to cling on to that idea, but by and large, no. I mean, those people have just exited out because it's just not practical to do that. You've either got to grow it into a portfolio of a large number. Well, I don't know how large precisely that number is, but I suspect it's into the many millions. So you've got to leverage, you've got to borrow, you've got to take risk, And I'm sorry, but most retirees are not going to want to do that. So really, it the idea of people doing a pension plan of properties is, yeah, it's not what it used to be, shall we say? So all of that is positive for Watkins Jones because, of course, um, the the impact of all these properties coming off the market will be that rare, rental properties become scarce, and scarcity drives up the price of rents. And we can see that if you go and look at rental, and I've included it in past articles where rental rates were increasing strongly. So if you are a landlord, you're making good money because you're making good margins because you don't have much competition because your competitors are leaving the market. So that kind of allows you to up your prices because what are the renters going to do? They can get themselves into a bidding war over your property because you're the only guy that can provide it, so to speak. So it's I'm not saying that's right, but that's what's happening increasingly. And I think there's a lot of variability across the country as well. Not all areas and regions will be as fiercely competed over as some, but yeah, this idea of that you can see here with these charts that the number of properties leaving is in beige, the number of properties adding is in blue, and you can clearly see that there's a very, very big disconnect. And obviously that doesn't take into account the increasing number of renters as well. So there's that to contend with as well. PBSA kind of similar, really. That there's some that might say that the number of students is dropping. It's not true. And you've got to realize as well that some of the people under the first segment, the build to rent, so people that are renting, might be students. In fact, there's more students in private landlord, houses of multiple occupancy (HMOs) than there are in halls of residence. And in years 2 and 3, and for postgraduates, that's generally the preference, that you want to get accommodation with your friends, your circle of friends, and so you share a house, and that's quite common. It's less common for what they call returners to be returning to student accommodation, as in student halls of residence, as I would call them. So PBSA, something like a 43% reduction in HMOs, which again is just going to drive up prices and drive people back to PBSA, because at the end of the day, if it's not practical to get a house with your friends, you're going to go into a hall of residence. What choice do you have? That's just the reality. So the delivery, when you look at under construction properties, under construction PBSAs, well, that number's dropping away substantially, and has been dropping away for years. The red is the sort of average delivery, and we can see that we're at about what 10,000 beds being added per year, maybe a little bit more in the current year, but it's dropping away. And meanwhile, we can see that supply, so older properties are being removed from the market at a rate of about 10,000 a year, and the number of students has increased. It's not as though the demand is dropping away. No, the number of students has increased year by year. So again, you've got all of the dynamics of demand and supply. And yeah, when we look at how things stood a year ago, so when we looked, this is from the 2024 accounts, the total secured pipeline was 4856. It's now 5294, so it's up by about 10% from a year ago. And so again, the outlook is looking better and brighter for PBSA. And the only thing I would point out is the forward 2-year position was stronger here. So 2 year, 1 year ago, the 2-year forwards, which was 2026, stood at 400. It's now at 200, but you can see there's this big lump now in the current year of 3 years ahead, whereas it was only 300, it's now 1600. So you can sort of see it's, there is a hiatus 2 years ahead, which we'll come on to in a minute. But that's kind of where we're at with the PBSA. And again, we can see here there's a bit of a bump, shall we say, but this is a one-off cost. So the gross margin actually increased to 9.5% gross margin, but the operating margin dropped to 3.6 because there was a write down and a couple of things that they disclose in the exceptions, which caused that profit margin to drop. Affordable homes remains dreadful. You do it because you have to, not because you want to. So I've kind of said, from now on, I'm going to just lump in the results here with the build to rents, the BTRs, because you're only delivering affordable homes as part of delivering a BTR project. There's no reason that you would want to lose 1.1 million pounds willingly. At least I hope you wouldn't. So that one is kind of a complete non-starter as far as that goes. But that's the performance there. Refresh, I think this is particularly exciting, and they've delivered about 10 million a year. They've only been doing this like a year, just over a year, but they've delivered about 10 million turnover a year. But they're now telling us that they've got a pipeline of 300 million. So 300 million is equivalent to 30 years worth of 10 millions. Um, uh, and that 40 million is in exclusive negotiation, 50 million is at bid stage. And again, 40 plus 57, that's kind of equal to about 10 years of last year's run rate. In other words, the run rate is about to increase by quite a bit. And there is another chart where they sort of talk about the share going from about 70% traditional and 30% hybrid, as they call it, which is the joint ventures and the refresh, to be in a mix of 40% refresh and joint venture, where joint ventures would still be uh, build to rent or PBSA, but rather than just doing it as a contractor, as a main contractor, they're doing it as a part owner of the project. So Watkins Jones will take maybe 5% of the value of the project. So if it's, I don't know, 100 million or 200 million, let's say it's 200 million pound project, gross value, gross development value project. Well, if they've got 5% of 200 million, I mean, that's worth 10 million. So let's say they spend 80 million developing it, on that they make 10%, 12%. So they make 10 million there. But then because they part own it, obviously what's cost the project, let's say, 100 million to develop, that they're going to sell for 200 million gross development value. Well, 5% of that, in my example, 100 million profit, that's another 5 million profit. So essentially, what would otherwise be a 10 million profit turns to 15 million profit because you're the part owner of that project. I mean, whether you make 50% margins on a on a development project is very open to question. It's probably not as generous as that, but you get the idea that you get an extra tickle for being a part owner, and obviously you're risking your capital and you're risking, you know, if your main contractor, i.e., yourself, overruns or something happens that that obviously it's risk capital. But that's the idea, that they're sort of doing these joint ventures because that's the way forward. That's the way to kind of unlock. And the interesting thing I think as well about the refresh business is that, I mean, that there's a lot of it, but also that it's kind of can lead to other things. Like a refresh project can lead to another refresh project. A refresh project can lead to a fresh, essentially an accommodation management project where you get fees for managing a hall of residence. It could lead to a further traditional project. So there's lots of kind of synergies to all of this, which is pretty interesting as well. And you can see here the margins are pretty strong, although they do tell us that these margins are going to drop in their presentation. We then have the fresh. So what we see here is the number of units under management have increased. That people are happy. Net Promoter Score 62. So it's kind of all heading in the right direction. They do say that they've lost a few projects, a few units in the past year. So there's kind of, it's kind of static, but their revenue is up a little bit. So this one's kind of not really going anywhere fast, but that's that's kind of the performance there. And we once again, just as we saw in the second half of last year, we see this mysterious loss occur here, and we don't really know. No explanation is given for why they lose. But what I've done is I've taken the full year to work out, or sorry, I've taken the first year result to work out the second year result, and so yeah, hidden away in the second year result is the fact that they actually lost some money, but they don't say why. Moving to cash and cash management, I mean, there's once again, there's no real there's a very strong cash position. They've got well, net 70 million plus 10 million the day after the end of the accounting period, so it's really 80 million by all accounts. And the market cap's only 70, so it's very well capitalized. It's you essentially, if you bought the whole thing and stripped out all the cash, you'd have pretty much the business for about 10 or 15 million pounds, where you'd have a business for worth uh, um, about 50 million pounds for about 10 million pounds. So you'd be buying it on something like about an 80% discount to its NAV once you stripped out all the cash and working capital, which obviously is terrifically cheap, especially if it's about to rebound and to bounce back and start making some real profits. This is the pipeline. Now, I've done a bit of work around this, and this is one of the changes I've made to the article I released this morning. And I was sort of thinking about how I could sort of take these pies and take their disclosures and turn it into some interesting data, which is what I've done here. So what I've done is I've stripped out all of the forward sold by year, so 2026, 2027, 2028. What I've done is I've taken the number of units. Now, this is the bit where you're going to have to sort of decide whether you're happy about this. But if they've got this many units, so 1,686 units, and they've disclosed that they're worth 94 million pounds, I'm saying, well, 85% of the units then is worth 85% of that 94 million pounds, which would be 80 million or 79.5 million pounds. So I'm just pro-ratering everything. I appreciate there may be, gold standard PBSA and Joe Schmo PBSA, and one unit might be a more expensive unit than the other. There's no real way of catering for that. So all I'm doing is I'm just saying, like, take the proportion of these numbers to work out the proportion of these numbers, the forward sold, the 340 million that we know is forward sold, to get kind of this is what comes out at the other end, of broken out by build to rent, PBSA, and other. How much is 2026, how much is 2027, and how much is 2028. What I've then done is I've added, I've done the same with the forward sold, again taking the year. So if it's in 2026, I'm assuming it's going to turn from green to blue. It's going to go from forward sales to sold, and taking the value of that, once again taking the pro rata of that. That gives me, oh sorry, what I've then done is I've done a slight increase on fresh, but not very much, literally a few 100,000 a year for the next 4 years. So you might say, well, actually that's a bit pessimistic, Oak Bloke, and you should up your numbers there. But it's small beer, so I don't think it really matters. The only bit you might take is issue an umbrance where there's this bit here, refresh. So I'm saying it's going to grow from 10 million to 75, which you might say, wow, 7.5. But when you look at the numbers where they've got 40 million in like kind of in the bag, 55 million in negotiation. So, say half of that comes in. I mean, that's 75 straight away. That's just on what is already there today, let alone what's happening in the next 12 months. So, and because these projects are quite quick turnaround, they're not kind of, you know, planning permission and these things take months and years. No, you kind of sign the deal with them. They schedule it in, start the work. It's a couple of months. It's a much quicker turnaround. So I think if anything, 75 in the coming year and then 80 growing to 90 could be quite small. It could be bigger than that, actually. I mean, they've got a pipeline of 300 today plus whatever else they find during the year. So anyway, that kind of gets us to these numbers here, which I've plugged into here, which you can sort of see there, 279 million in the current year, for 2025. Well, the pipeline is already, including that fresh and refresh, if you agree with those numbers, the pipeline is already higher than the current year, and the year has only just, well, the year, we're 2 months, 2.5 months into the year. So it it kind of feels very positive for the coming year, that there is already a turnaround, and that's just taking the existing numbers as they stood at the 30th September. That's not sort of doing anything beyond, apart from that supposition around refresh. The bit that sort of is a bit of a gap is here, that obviously that drops away, but then the forward view, again, the 2028, the 2029, that's just a run rate number there. But again, that sort of looks very, very positive. So all in all, um, I mean, yes, there's some negatives around the cladding. I've kind of worked through the numbers there, and the 48 million liability has only shrunk to 46, so that's not much of a drop. And there's some new liability added in, so that will certainly be taken as a negative. There were some other exceptions as well, so I talk about those in the article here as well, of exceptional costs. I think all in all, when you say, there's a decent pipeline, there's more to come, so that's where I've included that I've just shown you. Um, when you look at the macro, this is sitting behind this with government policy and just the number of people that increasingly need and want to rent and can't, and that's going to drive up prices and therefore drive up the attractiveness, fall in interest rates. There's just lots of things that I think are a positive backdrop to all of this. And yes, I mean, you can paint a negative story around this, but I think to conclude, it feels like a share that's got far more to go, far more to run, and that's why I'm keeping it going as an idea. So I hope that's been useful. That concludes everything, and thank you for listening. And cheerio for now. Cheerio.